All right, hello and welcome to week 3. It looks like I'm the only one on so far, but that's okay. I'm used to it. So hopefully somebody joins us a little bit later. Let's see, I do have a couple announcements. Is there anything here? Yeah, that's old news already. We'll try to always remind you on Sundays what was due that weekend, in case you haven't done it. There were some activities from week 1. There was the DEI quiz and the orientation quiz. Some folks submitted it late, so I did spend some time on Sunday making sure that I've given credit to those people who took it late. If you have not received credit, take a look in grades, and if you don't see credit for your DEI and orientation quizzes, and you did take them, then let me know and I will check that out. Or if you took it anytime after Sunday afternoon, let me know and I'll go ahead and give you credit on those, okay? Because I'm not gonna go back and keep checking since most people have completed those by now. There was the Startup Factory this weekend. I don't know if anybody from this class went. I did have about 4 students that went, and there was a student from a previous online financial accounting class who was there, which was kind of neat because I'd never met her in person, and she walked up and said, "Oh, I was in your financial accounting online class." And now she's a student at Cal State UMB finishing up her bachelor's. And there was another student from one of my face-to-face classes who also had transferred to CSUMB. So it was pretty neat. I'll let you know if any other entrepreneurship events come up at CSUMB this semester. Actually, I think we might even have 1 or 2 CSUMB students in this class. But I'll let you know if anything comes up that might be of interest to you. They have some really great entrepreneurship and business programs and accounting programs over at CSUMB. And this was a lot of fun. Teams got to build their own businesses and then pitch them in front of a panel. But anyways, enough on that. If there is anyone in this class who was there, let me know and I'll make sure you get extra credit for being there. Because as far as I know, there wasn't anybody from this class. Okay, those were all the things I wanted to touch on. So I think we're ready to go into chapter 3. Welcome, Jane. And it looks like you're the only one here so far, but sometimes we have students joining a little bit late. All right, chapter 3, we are going to go through the exercise set, and then we have a few problems we'll look at as well. Okay, this chapter is where we get into analyzing and recording transactions. So far, things have been fairly conceptual. We've been dealing with new terminology, concepts. Now we're going to get into some more of that, but also some actual calculations, some math. And don't worry, it's not super hard. Let's see, how many exercises do we have? 25. So this is, I think, our longest exercise set of the whole semester, although some of them go pretty quickly. This first one is going to take a little bit of time. If you have viewed the recorded lecture or if you have read the chapter 3 in the textbook, then you've learned some of the concepts, principles, and assumptions that relate to, did I start recording? I did, okay, sorry. Some of the concepts, principles, and assumptions that relate to GAAP specifically, and that's what this first exercise is about. So what we're going to do is we're going to read the explanation on the right and then match it up with the term on the left. So Jane, if you think you've got the answer for any of these, feel free to type it in the chat or you can unmute. Starting off with, if uncertainty exists in a potential financial estimate, A company should err on the side of caution and report the most conservative amount. That word conservative, that is our clue, because the answer here is conservatism. So E goes with Roman numeral 1. Okay, so if there's a gray area and you're not sure which amount do we put, the most conservative, which is generally the one that is least profitable. So the higher cost or the lower revenue. All right. So that is Roman numeral 1. Welcome, Miguel. We just got started on the exercise set. And let's go to exercise 1, Roman numeral 2, also known as the historical cost principle, states that everything the company owns or controls, its assets, must be recorded at their value at the date of acquisition. So again, we have a little clue. This is the historical cost principle, also known as the cost principle. Okay, so A is Roman numeral 2. And this is important because let's say a company buys a building, whatever's the cost of acquiring that building is what they record as the value of that building in their accounting records. And then it doesn't matter if the market price goes up or the market price goes down, the value of that building stays the same. It stays at whatever the original acquisition cost was. All right. Let me know if you have any questions. Number 3, also referred to as the matching principle, matches expenses with associated revenues in the period in which the revenues were generated. What this means is the costs of producing a product, we don't count as an expense until we actually sell the product. So when we have revenue from sales, then we can match the cost of the inventory with the revenue. And that's called the matching principle, or it's also called the expense recognition principle. Welcome, whoever joined us there by iPhone. Next, we have number 4. Business must report any business activities that could affect what is reported on the financial statements. You must report any activities that could affect the financial statements. That is the full disclosure principle. So that is Roman numeral 4. Then 5 says system of using monetary unit by which to value the transactions such as the US dollar. That is D, the monetary measurement concept. So D is Roman numeral 5. In other words, everything we do in financial accounting has to be in dollars and cents so that it can go on the financial statement. In managerial accounting, there will be some accounting that happens that is not monetary in nature. But in this class, we don't have to worry about that. Then we have number 6. Period of time in which you performed the service or gave the customer the product is the period in which revenue is recognized. That is the revenue recognition principle. So what it's saying is if a customer pays you for a product, but you didn't give them that product until next month, well, then you don't count the revenue until next month when you give them the product. So we can only count the revenue when we've provided the product or service. And the last one, number 7, obviously that must be C. So 7 says a business may only report activities on financial statements that are specifically related to company operations, not those activities that affect the owner personally. In other words, the owner's finances and the company's finances have to be tracked separately. So if you've got your own business, you really want to have a separate bank account for your business and not mix it up with your personal finance. All right, so those are the answers for exercise number 1. Any questions on this? All right. Let's go on to number 2. This one's actually quick and easy here. We have these 4 different accounts, and we have to figure out, is each account an asset, a liability, or equity? So if you know, go ahead and tell me. Accounts payable. What type of account is that?
It's a liability account.
You are right, Jane. It's a liability account. Anytime you see the word payable, that is a liability. And guess what? D is also a payable, right? Notes payable. So that's going to be a liability as well. What about cash?
An asset account.
That's right. Cash is an asset because it's something we own. And dividends. What do you all think? Asset, liability, or equity?
Equity.
Equity. That is correct. It's an equity type of account, and dividends reduce equity, right? Because what a corporation does when it has a profit and it decides to give some of that money back to the investors, it's actually the board of directors that makes this decision, and they take some of the profits of the company and they give it away to the investors. So the dividends that are being paid are equity that is leaving the company and going to the investors in their pockets. So it becomes their money. So yes, dividends are an equity type of account, although they reduce equity. Same thing with expenses. Expenses are an equity type of account that also reduce equity. Then we've got common stock, revenue, gains. Those are equity types of accounts that increase equity. Great, let's go on to number 3. In 3, we've got 2 companies. The first company here is Gianni. We know their assets, we know their equity. How do we figure out their liabilities? So we're going to take the assets. Remember, the accounting equation can be stated multiple ways. You could say assets equals liabilities plus equity, or assets minus liabilities equals equity, or assets minus equity equals liabilities. It works all 3 ways. So we could take assets minus equity equals liabilities. And if we wanted to check that out, remember our assets here should equal our liabilities plus equity. So let's add the liabilities plus the equity, and it does equal our assets. For Forest, we know assets and liabilities. So again, we can subtract and we get the equity. Okay. For number 4, we are going to indicate whether each of these accounts is an income statement account or balance sheet account. The instructions also make reference to retained earnings, but I'm just going to give you a hint. None of these are accounts that impact retained earnings directly. All right, so just tell me, is this income statement or balance sheet? Which of those financial statements is impacted by insurance expense?
Income statement?
Yes, you are right, Jane, because the income statement is revenue minus expenses, right? So any expense is going to impact the income statement. How about accounts receivable?
Balance sheet?
That is right, yes. Accounts receivable is an asset, and the balance sheet is made up of assets, liabilities, and equity. Now, accounts receivable, in case you don't remember, that is money that we're going to receive from our customers because they haven't paid us yet, right? And that's why it's an asset. Even though we don't have the money, We know that they're going to pay us, because if they don't pay us, we're going to go after them with our collections department or a collection agency, or maybe even take them to court, right? So it is possible that we'll never get paid. There are some customers, out there that just never pay. But for the most part, we can expect we are going to get that money, so we can go ahead and count it as an asset. All right, so that is correct. Now, office supplies are an asset as well. So those are also going to be on the balance sheet. Once we use the office supplies, then we count the used supplies as an expense. But the unused supplies are an asset. Then we have sales revenue. Where's that going to show up? Income statement or balance sheet? Any guesses?
Wouldn't it be equity? Because it's a revenue? Oh, no, revenue
Yes.
will be income statement, right?
Yes, you're right. So revenue is an equity type of account, but it doesn't show up on the balance sheet. And the reason for that is the revenue goes on the income statement, so do the expenses, right? And then that tells us our net income or loss. And the net income or loss then goes on to the retained earnings statement, and the ending retained earnings goes on to the balance sheet. So the revenue does have an indirect impact on the balance sheet, but you're not going to see that account actually listed on the balance sheet because it's already absorbed into the retained earnings. So yes, the correct answer here is income statement. Revenue and expenses are equity types of accounts, but they go on the income statement and then eventually influence the balance sheet. Okay, how about common stock? Where's that going to show up?
Under equity?
Under equity on the balance sheet. That is correct. And notes payable. We said payables are liabilities. So which financial statement will this show up on? Liabilities go on the balance sheet, right? Assets, liabilities, and equity. Okay, so you'll get the hang of it, but that was pretty good. These are the correct answers. If there are no questions, let's go on to number 5. So they gave us information here from a trial balance. And just to refresh your memory, if you take the balance of every account in the ledger, so you look and see how much is in our cash account today, how much is in our sales account. So you take the balance from every single account, you list it on one document, we call it a trial balance. And it's a way to check, because some of the accounts will have a debit balance, some will have a credit balance. And if you add up all the debits and all the credits on your trial balance, they should equal each other. And we do 3 trial balances in the accounting cycle. So in the process of taking transactions, putting them in the journal, copying them from the journal to the individual accounts in the ledger, then we make our first trial balance. It's called the unadjusted trial balance, because after that, then we make some adjustments. And then we have the adjusted trial balance. Then we can make our financial statements. That's the 7th step in the accounting cycle. And our 8th step is we close out some of the accounts. We haven't talked about that yet. The 9th step is we make another trial balance, and that is the post-closing trial balance. That is the 9 steps of the accounting cycle. And then there's a 10th optional step. So last week, well, okay, now I'm confusing myself, so I'm just going to stop talking. But what they've given us here is information from a trial balance. And then we're going to use that to make an income statement, I think. Yes, an income statement. Oh, and then we're going to make a statement of retained earnings, and then we're going to make a balance sheet. Okay? And this is not too hard. So first step, we need to make the income statement. We always start with revenue, right? Income statement is revenue minus expenses. In this case, though, this is a service company. It's a, what are they? Doesn't really tell us. Cromwell Corporation. They provide some sort of a service and they charge a fee. So their revenue is from earning fees. Sometimes you'll see sales revenue, sometimes you'll see sales. So sometimes you'll see rent revenue. It all depends on where that revenue is coming from. In this case, it's fees that the company earned. So that is their revenue. Then we need to fill in the expenses. The company has 3 different types of expense. They have rent, they have electricity, and they have some other expenses that they just put under miscellaneous. So if you've got certain expenses that really don't recur, and they, just one day you have to go out and buy a birthday cake for the office, another day you have to go out and, I don't know, buy a new stapler, you might just put that under miscellaneous expenses instead of having a stapler account, right? And a birthday cake account. But you don't want to do that too much, because then if you get audited, the IRS is like, what are all these miscellaneous expenses? Now, sometimes in financial statements, we use multiple columns and then we subtotal. But in this case, because it's nice and short, we're just going to do it all in one column. So just keep that in mind. We're going to take these 3 different expense types, add them together, and I calculated $15,070 of expenses. Now, if we subtract that from the fees that we earned, we will get our net income. Okay. Oh, what is going on here? There we go. I think I fixed it. Okay, so fees earned. Oops. I missed a 0 down there, didn't I? Is that right? Yeah, okay. I think that's right. So fees earned minus the expenses, 7,780. Okay, that tells us our net income. Any questions on the income statement? So next is the statement of retained earnings. I don't think we've done one of these before, but they're pretty simple. You take your beginning retained earnings from the beginning of the period, you add any net income, or if there was a loss, then we would subtract the loss. You take out any dividends that have been paid, because again, that's coming out of the profits of the company. So you're reducing the earnings that you've retained in the company by paying them out to the investors. And what's left over is the earnings that you have retained, right? So it's your ending retained earnings. So again, we'll start with beginning retained earnings, and we can find that here. When data are given to you, they always give you the beginning retained earnings, and then you have to figure out the ending retained earnings. So beginning retained earnings minus the net income that we just calculated. I'm sorry, plus the net income. Okay, so 11,380. So what we know so far, at the beginning of the year, we had $3,600 of profits remaining that we hadn't spent, right? So we still have those $3,600 of profits. And then this year we earned another 7,780. So that gives us this much. Now, out of that, did we pay some dividends? Yes, we paid $2,500 in dividends. That reduces our profit. And the outcome is 8,880 is our ending retained earnings. Okay, so we needed the net income to figure out our ending retained earnings. And now we can make our balance sheet. Any questions before we move on? All right, so the balance sheet. Remember, the balance sheet is as of a particular day, right? It's not for a period. So it's the last day of the period is the day that we are working on. If you notice the retained earnings, we calculated that was the ending retained earnings as of December 31st. And we are also doing the balance sheet as of December 31st. First thing we have to do is put in our assets. So let's go up here. Oops, I went too far. We're going to start with cash. And then we'll put accounts receivable of 2,580. So cash and accounts receivable. Then we need supplies and office furniture. The supplies are 865, and here is office furniture. Let's add these assets up. So I got 20,825 as the total assets. Next, we have the liabilities section. The only liability this company has is accounts payable. So let's go up here. Accounts payable is 1,945. Now remember, these two look alike, but accounts receivable is an asset because it's the money we're going to receive from our customers. Accounts payable is a liability because it's the money we owe to our suppliers that we have to pay later. Okay, so that is our one liability in this example. Common stock, that is part of stockholders' equity. So we go up here. We have issued $10,000 of common stock. So we put that in there. Now, retained earnings. Remember, we just calculated the ending retained earnings. So we don't want the beginning retained earnings. This sometimes confuses students. They put in the beginning retained earnings. No, that will give you the wrong number. You want your ending retained earnings from the end of the year. If we add that to the common stock, our total equity is 18,880. And this is what I was saying before. Remember, these equity accounts, revenue and expenses, gave us our net income, right? Our net income is part of our retained earnings calculation, right? So retained earnings is an equity account. We added our net income, which is an equity account, and we took out our dividends, which is also an equity account that decreases equity. And that gave us our ending retained earnings, which went here. So that ending retained earnings includes the revenue and expenses and dividends. All those calculations already went into there and became one number, retained earnings, right? So even though we think of this as the equities or equities section of the statement of the balance sheet, sorry, it's been a long day. Even though we think of this as the equity section of the balance sheet, some of that equity was calculated on the income statement, then on the statement of retained earnings, and finally made its way to the balance sheet. And now, if we add our liabilities to our stockholders' equity, we should get a number equal to our assets. So let's try that. Liabilities plus stockholders' equity equals 20,825. So exactly the number we were looking for. Our assets equal our liabilities plus equity. It's beautiful how it works, right? Any questions on exercise number 5? Actually, we did do a lot of number crunching last week, now that I think about it. Okay, exercise number 6. So here's a new term, original source. This is a document that gives us information that we need for our accounting records. So that means it's something that we've received. When we look at it, we say, oh, here's some information that now I need to put into our accounting records. Prepaid insurance is not that. Prepaid insurance means we bought some insurance and we paid in advance, which is usually how you pay for insurance. So that is not an original source. It's an asset. A bank statement, however, is an original source. It's a document that when we receive it, we could look at it and say, oh, look, here are some fees I didn't know about. So I need to subtract that. I need to list that on my bank fees account and reduce it from my cash account. Or maybe we look at our bank statement and we see, oh, there's a deposit that I didn't know about. There's some money that came in. Maybe a customer made a payment directly to our bank, which actually does happen. Sometimes companies have their bank receive payments for them. So in either case, there's information on the bank statement that we then need to put in our accounting records. So B is one original source. C is also an original source. It would be, for example, if you go to a restaurant where they don't have a computerized system, and so the salesperson just writes everything down on a slip of paper, and then they take that back to the kitchen, right? And then later maybe they add it up and they bring it back to you. So you've got this sales ticket that says how much you owe, right? If there's not a computerized accounting system, then the accounting person for that restaurant is going to need to add up all those sales tickets to figure out how much sales revenue there was. I remember back in my 20s when I was a restaurant manager at one point, and that was part of my job. And sometimes I was up to like 3 in the morning trying to reconcile all these sales tickets. So that is an original source document as well. Now, the general journal, as you might recall, that's where we list every financial transaction that occurs in one long chronological list. So that is not an original source document. That is an accounting tool. The trial balance is another accounting tool where we list the balance of every account. We make sure our debits and credits balance. The balance sheet is a financial statement that we can create. So that, again, is not an original source document. But G, telephone bill, is. When you get your telephone bill, then you know what your telephone expense is, right? So that would be information that would go into your accounting records. Same thing if you got an invoice from a supplier, then you know how much you have to pay that supplier. And so you would put that in your accounting information. You might know even before you got the invoice, but you could at least confirm it when you got the invoice that yes, that is the correct amount that we owe. And then I is an account, a sales account, so that is not a source document. An income statement is another financial statement. Okay, so the only original sources here were B, C, G, and H. All right, any questions on number 6? All right, let's go to number 7. We did something like this last week, I believe, where we had to look at the impact on assets, liabilities, and equity. And so that's what we're doing here as well. Every transaction has at least 2 impacts. And those impacts are on assets, liabilities, and or equity. Okay. The first one here, we received some cash from an investor because we issued stock to that investor. Okay, so those are the 2 sides of that transaction. In our double entry accounting system, every transaction has at least 2 different accounts that are impacted. And what we have to think about here is those accounts that were impacted, are they assets, liability, or equity accounts, and are they going up or down? So if we received cash, what type of account is cash?
Asset,
Asset. And did it go up or down if we received cash?
up.
Up. Okay, so we're just going to put A for asset and a plus for up. Now we issued common stock. So that's the other impact. That issuing of common stock, is that asset, liability, or equity?
Equity,
It is equity. That is correct. And it is also going up. Now this is a little confusing because we know that the investor bought the stock, right? So they gave us money. So the company got money, its assets went up. And we say that we sold the stock to the investor. Well, really, the stock is just a reflection of what portion of the company the investor owns, right? So it's not like the stock is actually leaving the organization, right? It's still ownership in the company. So when we issue stock, we are saying to the investor, we received your contribution, the money that you invested, and that is increasing the equity in the company, and you own this portion. Okay, so if they give us $10,000 of cash, we give them $10,000 of stock, right? But it's still equity in the company, so our equity has gone up. And so that's the first one. Assets went up and equity went up. Now, remember the accounting equation, we see it right here. Assets equals liabilities plus equity, right? That has to stay in balance. So in this case, assets went up, and then on the other side of the equal sign, equity went up. So we're still in balance. And with each of these transactions, the accounting equation always will stay in balance. Let's look at the second one here. We sold some goods. Okay, so we made a sale. Later, we'll learn about inventory. Don't worry about the actual goods and keeping track of that. The fact here is we made a sale to customers on account, so they're going to pay us later. Okay, so what are the two impacts from this transaction? Anybody want to take a guess?
assets, and equity.
That is right, Jane. Good job. Yes, so assets go up because remember, when the customer is going to pay us later, we call that an account receivable, and we treat that as an asset, right? Because it's like an IOU from the customer. So because they paid on account, assets went up. Because we made a sale, equity went up, because revenue or sales increases equity. Now, if they had paid cash, an asset would have gone up in that case as well, right? It would just be a different asset. Okay, now let's say the same customer that just made a purchase from us, but didn't pay us. Then the next month they've paid us, right? So they paid down their account receivable. In that case, we have an asset going down. But how did they pay down the accounts receivable? They gave us cash. So in this case, when they paid the money that they owed us, accounts receivable went down. That's one asset. Cash went up. That's another asset. That balances out the assets part of the equation. And there was no change to liabilities and equity. So we have a net zero change to assets, no change to liabilities and equity, and we're still in balance. Okay, any questions on that? The next one says we paid cash to vendors for supplies delivered last month. okay? If we paid cash, well, that's an asset going down. What's the other side of this transaction? We owed the money to our vendors from a purchase last month, right? Go ahead, Jane.
Liability.
Yeah, exactly. We paid down a liability. So our assets went down on one side of the equal sign, our liabilities went down on the other side. So we're still in balance. I think all of your answers have been perfect, Jane. I don't think you've missed a single one yet. So good job. And the last one, we purchased some inventory on account. Okay, if we buy inventory, that's an asset, right? We have the inventory, so that asset has gone up. If it's on account, that means we haven't paid for it. So we have a liability that's gone up as well. Okay, again, we're still in balance because A went up on one side of the equal sign, L went up on the other side, and we're in balance. All right, so that one was a little bit complex. I hope it makes sense. Does anyone have questions on anything from number 7? Okay. Let's go on to number 8. This has to do with debits and credits. Did I mention DEAL last week? The acronym DEAL. It's a useful acronym when we get into debits and credits, which we're doing now, because sometimes it's hard to remember when to debit, when to credit. And let's see, do I have an example? I think I have one down here. Oh yeah, here we go. Like here's a journal entry. In this journal entry, we received cash, so we debit cash. In other words, we record it in the left column. And we issued common stock, we credit common stock, we do that in the right column. So debit is the left column, credit is the right column. And one of the most challenging things for students is usually remembering when to debit, when to credit. So DEAL is an acronym that helps us remember. DEAL stands for dividends, expenses, assets, and losses. I'm just going to go ahead and write that down. Dividends, expenses, assets, and losses. Okay, so remember that the E stands for expenses, not equity, and the L stands for losses, not liabilities. And the reason this acronym is helpful is those are the account types that increase on the debit side. So in other words, if dividends increase, you record it as a debit. If expenses increase, you record it as a debit. Okay, same with assets and losses. Every other account type, when they increase, you record it on the credit side. Now, if an account increases on the debit side, then it's normally going to have a debit balance. And if an account increases on the credit side, it's normally going to have a credit balance. Okay, so let's go ahead and answer this. The first one is sales. Would that normally have a debit balance or credit balance?
Credit.
Yes, credit is correct. And we know that's correct because sales are not dividends. They're not a type of expense. They're not a type of asset, and they're not a loss. And by loss here, we're talking about when we sell an asset that's not a product and we lost money on it, that's a loss. So a sale is none of those things. Because when we say sales, we're talking about selling our product, right? Okay, what about dividends? Dividends are part of this DEAL acronym, right? We see them right there. So dividends normally have a debit balance. Office supplies, we know those are an asset, right? And we know assets are also part of the DEAL acronym. So they also normally have a debit balance. How about retained earnings? It's not part of deal, right? So that would normally have a credit balance. Accounts receivable. What type of account is accounts receivable?
Asset.
It is an asset, right? So it is part of deal and it normally has a debit balance. Now, we haven't talked much about prepaid accounts. If you prepay something, we consider it an asset because you own what you paid for, right? If it's January 31st and you've already paid for February rent, you own February's rent because you paid for it. Now, once February is gone, then you've used it up, right? And so then it becomes a rent expense. But when you prepay something, it is an asset. Assets are part of deal, so they normally have a debit balance. Same thing with prepaid insurance. It's an asset, so that would be debit balance. Now, wages payable. What type of accounts are payables?
Liability.
Exactly, right? So, and liabilities are not part of deals, so they normally have a credit balance. Buildings are assets, so they are part of deal, and they would have a debit balance. Expenses are also part of deal, right? So a wage expense is a type of expense, so that normally also has a debit balance. So these are the answers. The only ones with credit are A, D, and H. Everything else is debit. And I can confirm that. Where are we here? We did all that. We did that. Okay, here we are. So A is a credit. What else did I say? D is a credit. And H is a credit. Everything else is a debit. Any questions on exercise 8? Okay. Did say we have 25. All right, I better pick up the pace. I want to make sure we get through this by 6 o'clock, right? Okay, so I'm just going to go a little bit faster from now on. All right, so this next one is another one where we look at the impact on assets, equity, and liabilities. So again, we have to look at each side of each transaction. We paid a monthly note payment to the bank. So if we paid, our assets, cash, went down, and a note, I think I might have mentioned this last week, maybe not, a note is a loan, right? So it's a liability. And if we paid it, it went down. So we have an asset going down, we have a liability going down. For the second one, we made a sale on account. All right, on account means we have an account receivable, which is an asset. The sale increases equity. We bought some supplies. Okay, supplies are an asset, and we're going to be paying next month. So that's a liability, right? So we have an asset going up and liability going up. We got some cash from sales this month. So that would be assets going up from the cash, equity going up from the sale. And we paid for inventory we purchased on account last month. So cash is going down, so that's an asset going down, and we're paying down a debt. So we have a liability going down. Okay. Moving on, let me know if you have any questions. Otherwise, I'll just keep going. Again, here we have to figure out the normal balance. Well, expenses are part of deal. I'm going to go ahead and just copy this down for reference here for you. Expenses are part of deal, so they normally have a debit balance. Cash is an asset, debit balance. Equipment is an asset, debit balance. Rent revenue. Revenues are not part of deal, so they normally have a credit balance. Preferred stock is not part of deal, so that would be credit also. Interest payable is a liability, not part of deal, and that would be credit also. So we have 3 debits followed by 3 credits. Okay, any questions? All right, let's go ahead and do number 11. Now here, there's an extra wrinkle. Not only do we have to look at what account type it is and figure out, is this part of deal or not? But then we have to pay attention to, is it going up or is it going down? Because some of these say decrease. And if it's going down, we have to do the opposite of what we would do if it were going up. Okay, so cash increasing. Cash we know is part of deal, it increases on the debit side, so that's a debit. Supplies, however, are an asset, so they are part of deal. They would increase on the debit side, but they would then decrease on the opposite, on the credit side. Accounts payable is a liability, not part of deal, increases on the credit side. Common stock is also not part of deal, increases on the credit side, decreases on the debit side. Interest payable is not part of deal either. Increases on the credit side, decreases on the debit side. Last one, just the same. It's also a liability that would increase on the credit side, decrease on the debit side. So we have debit, credit, credit, debit, debit, debit. Okay, debit, credit, credit. Oops, that's not what I meant to do. Oh boy, okay. Here we go. Debit, credit, credit, debit, debit, debit. They put DR for debit, and that might seem weird because it's not debit, it's debit, right? Why would you put DR? And the answer is because it comes from Italian, and in Italian, the abbreviation is DR. So anyways, in case you were wondering. Number 12, all right. Same concept here. Let's go ahead and just copy this down for reference. Come on, here we go. Okay, equipment is an asset, it's part of deal. So if it's decreasing, that would be a credit. Common stock is not part of deal. So if it's increasing, that's a credit. An expense is part of deal, so it increases on the debit side. Revenue is not, so it increases on the credit side, but it would decrease then on the opposite, the debit side. Here's another, okay, well, this is an expense. So that increases on the debit side, increases on the credit side. And now we have a liability that's not part of deal, so it increases on the credit side, decreases on the debit side, okay? All right, CCDDCD. Clicked on the wrong thing. CCDDCD, okay? So those are the answers. I hope it's making sense to you. This one's a little bit different, 13. Here we have to figure out, does it normally have debit entries? Does it normally have only credit entries? Or is this an account that can really have both debits and credits? So accounts payable is both. Accounts payable is money we owe to our suppliers, right? So the more we buy from our suppliers without paying, the more that goes up. But then when we pay it down, it goes down, right? So accounts payable can go both ways. Cash can also go both ways. When we receive cash, it goes up. We pay out cash, it goes down. So it can both be debited and credited. Now, a gas and oil expense. Expenses are part of deal, so they increase on the debit side. So whenever we have a gas and oil expense, we would debit that account. We wouldn't really credit that account. That would almost never happen, right? Because how do you have an opposite expense, right? you use some gas and oil, that's an expense. How do you unuse it, right? So gas and oil expense is normally only going to have a debit entry. Rent revenue. Okay, rent revenue means we're renting something out to somebody and we're earning money from that, right? So that's revenue from renting. That is not part of deal. So revenue would be credited when it increases. And it never really goes the other way. How can you unrent something, right? Either you rent it to somebody or you didn't, but you can't unrent it. So it would normally only credit that account. Supplies expense, just like gas and oil expense, you can't unuse supplies, so you would normally only debit that account. And common stock, you issue it and you never unissue it, right? You could buy it back, but when we do that, we call it treasury stock. So common stock really only gets credited. Now, there are exceptions when we get into closing accounts. At the end of the accounting cycle, some of these accounts do have to get closed out, and that's the only time that you would do the opposite thing here. But in the normal circumstance, these first two are both, and then it's debit, credit, credit. Both, debit, credit, credit. It's hard to say. Okay, so that's number 13. All right, if there are no questions, we are going on to 14. Okay, do these increase with a debit or credit? So cash we know is an asset, increases with a debit. Common stock is not part of deal, it increases with a credit. Equipment is an asset. Accounts payable is a liability, not part of deal, so it increases on the credit side. Fees earned is a type of revenue, so it's also not part of deal, increases on the credit side. And expenses we know are part of deal, so they increase on the debit side. So here we have DC, DC, CD. DC, DC, CD. All right. Number 15. Okay, now we've got some journal entries. These are going to go pretty quickly because for the journal entries, I usually provide you with the account names, and all you have to do is fill in the number, which is really easy. There will be some future chapters where you have to figure out what's the right account name, and that could be a little bit challenging, but for now, you don't have to worry about that. Okay. So our first transaction here, the corporation was just started. The very first transaction is the investors invest $50,000 of cash. So the company gets $50,000, and we know that cash, when it goes up, gets debited, right? And the company issues $50,000 of common stock. We know common stock is not part of deal. So when it increases, it gets a credit. So we have $50,000 on the debit side and $50,000 on the credit side. Now, don't think of that as $100,000 because it's not, right? We got $50,000 of cash, and then we gave out $50,000 of equity. And that's just the way our double entry bookkeeping system works. You always update at least 2 different accounts for every transaction. Okay, question B. Sorry, something's tickling my nose. B says we ordered some equipment worth $4,800. Now, the problem with that from an accounting standpoint is we haven't paid for it and we haven't received it. So yes, we've placed the order, but we can't really count it as a financial transaction until either we've paid for it or the equipment has arrived and we've received it. So we have not paid for or received the equipment. That is the reason no entry is required. Okay, part C says we have purchased office supplies. So if we purchase them, that means we already have them, right? It doesn't say we ordered them, we actually purchased them. So we have the office supplies. That asset went up, that gets a debit. And because we haven't paid for it yet, we have a liability. We know that liabilities are not part of deal and they increase on the credit side. So we credit accounts payable $750. D says we hired a part-time worker. It tells us how many hours they're going to work, how much they're going to make, but there's no financial transaction yet because the employee has not started working, right? We haven't paid them. They've not done any work. So that's why no entry is needed at this point. We have not paid the employee and they have not started to work. Okay. Then E says that equipment that we ordered earlier, remember from B, that arrived along with an invoice, which is an original source document telling us that we owe the money. So now we have $4,800 of equipment. That's an asset, so it gets a debit. And we owe $4,800. Again, liabilities get a credit when they go in. Okay, so we are done with 15. Let's go on to number 16. Here is another one where we're showing the impact on the accounting equation. So an investor has invested, there we go, $25,000, and they received stock in exchange. Okay, so in this case, assets have gone up because the company received $25,000. And I'm just going to go ahead and write it as an accounting equation. So assets went up. Liabilities did not change, right? When we sell stock, we never have to buy that stock back. We have no liability. However, equity does go up because when we issue stock, that increases equity in the company. So equity went up. So what we have is assets went up, liabilities stayed the same. So I just indicated that with a 0, and equity went up. So we have assets on one side of the equal sign going up, equity going up on the other side. We're still in balance. The second one here, B, says services have been performed. So we earn some revenue. And let's see, 60% was paid in cash. The rest was going to be paid later. The customers asked to be billed for it. So that's an account receivable. Well, both cash and accounts receivable are assets, right? So even though some of it was cash and some of it's going to be paid later, both of those are assets. Going up. Again, there was no liability for us in this equation, but we did provide a service. So we count that as revenue and that increases equity. C, an electric bill was received for $35. Payments due in 30 days. Okay. We've not paid it, so there's no change to our assets at this point. We owe the money, so our liabilities have gone up. And we have an expense. Remember that expenses reduce our equity. Okay. So again, assets equals liabilities plus equity. There was no change on the asset side. And the net change on the liabilities and equity side is that one went up by $35, one went down by $35. So they cancel out that side of the equal sign. Okay. So we are still in balance. Our assets are still equal to our liabilities plus our equity. D says some workers earned money and they were paid. Okay, so if they were paid, assets went down. And we incurred a wage expense. So equity went down. Okay, sometimes with payroll, in fact, usually with payroll, there's a period of time between when you figure out how much you owe and when you actually pay them. So it can often be a more complicated situation than what we see here. But for now, we'll just go with this one, the way they presented it to us. So assets went down. But what did I do? There was no change to liabilities. And equity went down. Okay. So that's the correct answer there. And E says we paid that electric bill from C. Okay, so if we paid it, we used cash, and our liability went down, and there's no change to equity because we already counted the expense previously, right? So we don't have to count it again. All right, so assets and liability went down. Okay, let's double check that because this is my third class today, and who knows if I'm making things up here, if I'm hallucinating, which sometimes happens in accounting. Which one are we on? Let's see, even right now, we are on 16, okay. 16, okay, so they wrote it out differently, but here we have assets and equity going up. Assets and equity going up, is that right? Okay, that's what we said. For C, we have a liability going up and equity going down. That's what they have here. For D, they show assets and equity going down. That's what we have. And then for E, we've got assets and liabilities going down. And that's what we have. Oh, wait. Yeah, okay, that's a mistake. So the answer guide that I have access to here actually has a typo. So I made myself a note that actually it is liabilities that went down, so we got it right. Assets and liabilities went down. Okay. Any questions on 16? All right, let's go on to 17. This is similar to what we've done before. Prepaid insurance is an asset. If it goes up, that is a debit, right? Utilities expense. Expenses increase on the debit side because they're part of deal. Commissions earned. Okay, now this is vague because we don't know by commissions earned, are they talking about our salespeople that work for us, or are they talking about the company as a whole? Which is less likely, but that's actually what they mean. They mean that the company has earned some commissions. Okay, well then that is a source of revenue. And revenue is not part of deal, so it increases on the credit side. Supplies are an asset, they increase on the debit side. Retained earnings, not part of deal, so it would increase on the credit side, but this says decrease, so that's a debit. Taxes payable, also not part of deal, increases on the credit side, decreases on the debit side. Unearned revenue. Okay, I think that term's come up before. Unearned is a liability. And what it means, unearned revenue means we got paid by our customer, but we have not yet provided the product or service. So we got the money, but we haven't earned it yet. So that's a liability because we have to earn that, and then that liability goes away. And liabilities are not part of deal, so they increase on the credit side. Expenses we know are part of deal, they increase on the debit side. A note receivable, okay, a note again is a loan. And if it's a note receivable, that means we lent money to somebody and now we're going to receive that money back. So for us, that's an asset, right? Because that's an IOU we have from that customer that they're going to pay us back. As an asset, it would increase on the debit side, but it says decrease. So it's credit. And common stock we know is not part of deals, so it increases on the credit side. So let's check this. I see the ones that are credit are C, G, I, and J. C, G, I, and J are the credits. Good, we got that right. And number 18, do these normally have a debit or credit balance? So unearned revenue, I explained, is a liability. Anytime you see payable or unearned, those are liabilities. So unearned revenue is a liability. It normally would have a credit balance. Office machines are an asset. They would have a debit balance. Prepaid rent is an asset as well. I think I explained that earlier. Cash is an asset. Legal fees earned, that is a revenue type of account. So it's not part of deal, and it would normally have a credit balance. Payables we know are liabilities, so they would normally have a credit balance. Dividends are part of deal. Remember, deal is dividends, expenses, assets, and losses. So dividends increase on the debit side. Accounts receivable are an asset, so debit for them as well. Expenses are part of deal, so they increase on the debit side. And retained earnings is not part of deal, so it increases on the credit side. So the credits we have here are A, E, F, and J. Let's see if that's right. Oh, I went too far. A, E, F, and J is correct. Okay, number 19. So a company has these transactions. We have to figure out what is their net income. So the first transaction is an investment from an investor. And that is not part of net income. Remember, net income comes from the income statement, which is revenue minus expenses, right? An investment of capital is cash that we received, and it's equity because we issued common stock, but it does not go on the income statement. So what we're looking for here is revenue, and we're looking for expenses. We bought some supplies. Supplies, when we use them, when they've been used, are an expense. Until they're used, they're an asset. So we bought some supplies on account. We have a liability, we have an asset, but we don't have a revenue or expense at this point. We bought some furniture. Okay, well, furniture is an asset as well. And we have a liability that we need to pay for. So again, there's no change to revenue or expenses. We provide services. Okay, services. If we've provided services, now we're earning some revenue. So we did $9,000 worth of work. That's $9,000 worth of revenue. We paid some salaries. Well, paying the salaries is cash, but if we paid it, it's because we had a salaries expense, because the workers earned that money, right? So that is an expense. And, oh, we paid this month's rent. Okay, this one's a little tricky. Because it is for this month, we can go ahead and expense it for this month. If we paid it last month, we couldn't have counted it as an expense then, right? But now that we're in this month, we can count it as an expense. Then we've got paying for supplies. Again, that's not revenue. And it doesn't say we've used the supplies, so that's not an expense. We collected money that customers owed us from a previous sale. That's great, but again, it's not revenue because the sale we already counted when it happened last month, and it's also not an expense. So for this one, we have revenue of $9,000 minus expenses of $5,000. So our net income is the difference, $4,000. Okay. 9,000 in revenue minus 5,000 in expenses. Everything else is important and would get journalized and would get recorded in the ledger and would show up on a financial statement somewhere, but is not part of the income statement. Okay, going on to number 20. We have some more journal entries, so that should go pretty quickly. All right, first transaction, we bought an asset, merchandise inventory, for $2,800. So in other words, we bought some finished products from another company that we can then resell. We call that merchandise inventory, and it's an asset, right? Because we own it, right? And we haven't paid for it yet, so we have an account payable. Sorry, let's try that again. There we go. Okay, so we debited the asset and we credited the liability. Our debits always have to equal our credits. Then on February 10th, we paid a creditor for part of our previous purchase, okay? We paid $1,600. So our accounts payable went down. Remember in part A, accounts payable was going up with a credit. Now it's going down, so it gets a debit. And cash is going down. When an asset goes down, it gets a credit. Okay, that's why you have to understand when to debit and when to credit, so you can fill out your journal entries and your ledger entries correctly. Any question here on number 20? This chair is really comfortable, but it's so comfortable that I kind of lean back into it, and then it becomes uncomfortable after a while. All right, number 21. Some more journal entries. We issued some common stock. So we got 15,000 from our investors. That's an asset getting debited because it's going up. And we issued the stock, so that is equity. It's an equity type of account. Common stock, when it increases, is on the credit side, right? Because common stock is not part of deal, so it increases on the credit side. The next transaction, we bought some supplies, which are an asset going up. And we owe the money. We know that liabilities, like accounts payable, are not part of deal. They increase on the credit side. Then C says we billed a customer for accounting services we provided. Okay, so now there's an accounts receivable because the customer owes us the money. So that's an asset going up. And we can count it as a sale because we did the work. And revenue is not part of deal. It increases on the credit side. Okay, hopefully you're starting to get the hang of it here, or maybe you've got the hang of it. Number 22, we bought some land. That's an asset going up. We paid cash. That's an asset going down, so it gets credited. B, we bought some more inventory. That's an asset going up. We haven't paid for it. So liabilities increase on the credit side. And we sold some merchandise for cash. Again, we're not worried about tracking the sold inventory. We'll get to that in a future chapter. But the cash went up because we received it. And sales revenue is not part of deal, so it increases again on the credit side. All right, now 23 is okay, it's not the one I was thinking of. But it is a new concept for us. We're going to start working with some T accounts here. T accounts represent the ledger. What we just did here is the journal. We took some transactions and posted them in the journal. Then that information has to get copied over to the ledger. So for example, on this first transaction, we would go to the land account in the ledger and we would debit the land account 22,000. We would go to the cash account in the ledger and we would credit the cash account 22,000, right? So we're copying these transactions from the journal to the individual accounts in the ledger so that we can keep track of each account. Oh, welcome, Maria. We are on exercise 20. So, and you'll be able to watch the recorded lab here later. I'll be posting it later on today. Okay, so now what we're doing in 23 is the ledger part. So imagine that these transactions were already recorded to the journal and we're copying each transaction to the individual account in the ledger. So these are called T accounts because it looks, if you just look at the line on the top and the line in the middle, it kind of looks like a T. And we use these to represent the ledger. Okay, it's just a little easier than actually putting everything that would be in the ledger. We just put the T account. The first transaction says we provided legal services to customers for cash. So we got $5,600 of cash. That would be a debit to cash. And we would go to the cash account and put a debit of $5,600. And we would also go to the legal services account and we would put a credit of $5,600. But for this exercise, we don't see that account. So just pretend like we did that, okay? And let's go on to part B. We provided some more legal services. So again, we would credit the legal services account and this customer didn't pay, right? So now we have an account receivable of $4,700, which is an asset. So it increased and we would debit accounts receivable $4,700. Okay. Then the last transaction, we collected $3,500 in cash. So cash went up $3,500, it gets a debit. And accounts receivable goes down $3,500, right? Because customers are paying us what they owe us. So that reduces our accounts receivable and that asset decreases. So we have to credit that asset. Okay. Now we can find the balance in each account. Cash had two transactions, we add them together. And we have a total of $9,100 in the cash account, right? Accounts receivable, we had $4,700 that was owed to us, but then we received $3,500 of that. So we have to subtract that. And the difference is a remaining balance of $1,200. So the way to think about it, in the ledger, we don't use plus and minus. We use two different columns. So accounts receivable, when it goes up, it's on the debit side. When it goes down, it's on the credit side. So think of this as minus. We're subtracting, right? Because it went down. So it went up 4,700, then it went down by 3,500, which leaves us 1,200 still remaining on the debit side. Okay. Any questions on exercise 23? Number 24 here is similar. So here we've got an inventory account and an accounts payable account. So we bought some inventory on account, $22,000 worth. So we got the inventory and that's a debit to an asset, right? And we owe the money, so that's a credit to the liability. Because accounts payable is not part of deal, right? Liabilities are not part of deal. So when a liability increases, it's on the credit side. Then B, we paid vendors for part of inventory purchased earlier in the month. Okay, we paid $14,000. So we'd go to our cash account and put a credit, right? Because that asset is decreasing. And our accounts payable is also decreasing, right? Then the last transaction, we bought some more inventory. This time we paid cash. So again, we would go to the cash account and we would credit it. And we increase our inventory by 6,500. And so now if we want to see our balance in each account, in accounts payable, we owed 22,000, we paid down 14,000. And so we still owe 8,000, right? 22,000 minus 14,000 is 8,000. Over here, we bought $22,000 worth of inventory, then we bought another 6,500. So it's a total $28,500 worth of inventory. Okay. And now we're at our final exercise. We also have 4 problems that we'll go through together. I think we're on track, so we will get out of here on time. Exercise 25. Here we are going to make a trial balance. All right, this is pretty easy to do. We take the balance from every account, which have been provided to us here, and we just put them in the trial balance. We're going to put the assets first, then we will do the liabilities. Then we do our equity accounts, starting with common stock, going on to revenues, and then expenses. Now you notice some of those accounts normally have a debit balance, so we're going to give those a debit. Some have a credit balance, so we'll give them a credit. And then when we add up our debits and we add up our credits, we should get the same number in both columns. So let's try it. Here's our cash. Here is accounts receivable. And our administrative expense. Okay, so those are all of our debits. Credits are accounts payable, common stock, and service revenue. Okay, let's add up our debits. I get 136,100. And on the credit side, same thing, $136,100. So if we'd gotten a different number, then we would know that there was a mistake, right? Because our debits always have to equal our credits, just like our assets always have to equal our liabilities plus equity. Okay, any questions on the exercise set before we move on to the problems? All right then, so we're going to do 3, 8, 9, and 13. I'm just going to write it here so I don't forget. 3, 8, 9, 13. Okay, problem number 3. So this first one is not super hard. So we know that assets equal liabilities plus equity, and these are all equity accounts. But we don't know what the liabilities are. If we can figure out what the equity is, we can subtract that from the assets, and then we'll know what the liabilities are. So how do we figure out what the equity is? Well, common stock, as you know, increases equity, right? Because it occurs when an investor has given money to the company, and then we create the stock. So the value of the company has increased by receiving that money from the investor, and the equity represents that increased value, right? So when we issue common stock, that is increasing equity. Dividends, on the other hand, that's taking profits out of the company, paying it to the investors, and so that decreases equity. Revenue increases equity, and expenses decrease equity, right? So if we calculate 160,000 minus 30,000 plus the revenue and then minus the expenses, I come up with $200,800. That is our total equity, right? That is the sum of these four. So 200,800. Let us subtract that from assets. So I'll take assets minus what I just put in memory, and we get 45,500. Okay, let's kind of check that. We can check it a couple different ways. We could take our assets minus the 45,500. That equals 200,800. So that checks out. Another way we could do it, this will work, I believe. We take our assets. No, okay, let's not do that. Let's do it like this. We know that assets equal liabilities plus equity, right? So let's take our liabilities plus our equity, which was common stock minus the dividends, plus the revenue minus the expenses. So in other words, I added all of this together, subtracting the negative numbers there, and the total I got was the same as assets. So every way we check it out, this works. So that is the correct answer there, 45,500. Okay, any questions on number 3? Then we've got number 8. Okay, this one is really not that hard. It's just a little different from what we've done before. They want us to look at each of these accounts and think, what is the normal balance, debit or credit? And is each of these accounts an asset, a liability? If it's a revenue account, we'll put R for revenue. If it's an expense account, we'll put X. And if it's any other type of equity account, we'll put an E. Okay, so let's do this. Accounts payable. Normal balance, again, thinking back to deal, liabilities are not part of deal, so the normal balance would be a credit. Just a second. I hear an alarm. Sounds like it might be on campus, but it's not this building, so I think we're okay. I'm okay. You're probably not even on campus, right? Okay, the account type here, accounts payable is a liability, so we'll give that an L. Supplies, those are an asset. The normal balance is a D. The account type would be an asset. Inventory, also an asset. Common stock, the normal balance would be credit because it's not part of deal. The account type is equity, right? It is an equity type of account, and in this exercise, they want us to specify if it's revenue or expense, and common stock is neither of those, right? Dividends are part of deal, so they do normally have a debit balance. What type of account? They are an equity type of account. They are not a revenue or an expense. And salaries expense is part of deal. And it is an equity type of account, but specifically it is an expense. So they want us to put an X. So that's what we will do. Okay. They meaning the authors who wrote this textbook. All right. So there we go. If there are no questions on problem number 8, we can move on to problem number 9. This is like what we've done before. We're going to show the full accounting equation for each of these 4 transactions. Here we have a sale, there we go. on account. So we have an account receivable, which is an asset going up. No change to our liabilities. And equity goes up from the sale, right? Then we have a payment on a note payable. Okay, we made the payment, so that's an asset going down. Our liability, the note payable, is going down because we made the payment. And our equity stays the same. The next one, we made a purchase of equipment, which is an asset, for cash, which is another asset. So we have an asset going up, another asset going down, right? Cash is going down. So the net change is 0, right? One asset went down, another, or down. One asset went up, another one went down by the same amount. That washes out. So the net change is 0, and also there was no change to liabilities and no change to equity. Collection of accounts receivable, okay? Accounts receivable is an asset. So if we're collecting that money, that asset's going down, but the money is an asset going up, right? So again, we have a net 0 impact on assets and no change to liabilities, no change to equity. Sometimes students say, but the accounts receivable was money that was owed to us. Right, that's the customer's liability. It's not our liability, right? For us, that accounts receivable is an asset. If we had an accounts payable, that would be a liability. And in fact, that's what we have here. We have purchasing supplies on account, that's a liability. And we have the supplies, that's an asset. So we have assets going up, liabilities going up, and equity not changing. Okay, so those are the answers there. Let's double check that just to make sure, again, that I'm not just making stuff up over here. We have assets and equity going up, assets and liabilities going down. Okay, that's right. We have no change, and then assets and liabilities going up. No change, assets and liabilities going up. Okay, so we got that right, and we have one last problem. So we are going to be done on time, maybe even a few minutes early. Okay, this one is a bit of a doozy, but it's not going to take us that long. So yeah, we'll be done early. But if you have questions, we can definitely continue and go over anything you like. So here we go. Mr. Hoskin here started his own business. These were the transactions from his first 2 weeks of business. And what we have to do is record each of these transactions. Normally they would get recorded first to the journal, and then they would get copied over to the ledger. But here we're going to put them directly into the ledger using these T accounts. Okay, so for every transaction, we have to think, what are the impacts? What account is going to get debited here, and what account is going to get credited? So the first transaction, Mr. Hoskin contributes cash of $12,000 and a truck worth $10,000, and he received common stock from his business. Okay. So cash went up by 12,000, right? And we know that when an asset goes up, it gets a debit. Truck went up by 10,000 because the company received a truck. So that gets a debit. And then Mr. Hoskin gets $22,000 worth of stock, right? So common stock goes up, and common stock is not part of deal, so that gets a credit. Now I made this easier for us because I put the boxes there. If we didn't have the boxes, we'd have to, figure out exactly how many debits and credits for each of these accounts. So this makes it a little bit easier, but it's still a little bit tricky. So we'll continue walking through it here. B, we paid 2 months worth of rent in advance, $800. Okay, so cash went down. That's a credit to cash. And prepaid rent went up. So that's a debit to prepaid rent because it's an asset and it went up. C says we agreed to do a hauling job. That's his business. He hauls stuff for people. And he agreed to do a job for $1,200, but he hasn't done the job and he hasn't been paid. So for C, we're going to go down here. No entry is needed because he hasn't done the job or been paid. Okay? So really, there is no financial transaction. There's an agreement, so it would be recorded maybe in a contract somewhere, but it's not an accounting transaction until either there's payment or we've done the work. Then we go to D, and now he's done the work, okay? So he did $1,200 worth of work. So we're gonna go down to hauling revenue, which is, remember, revenue is not part of deal, so it increases on the credit side. So we're going to put that $1,200 on the credit side. And the customer is going to pay him later, so we have an account receivable, which is an asset, so it increases on the debit side. Then E says we got a payment of $600 for that hauling job. Okay, so now the accounts receivable goes down because the customer paid $600 of it. So we credit accounts receivable, and cash goes up because we got that $600. F, we bought some gasoline on credit. So normally when you purchase an asset, you don't count it as an expense until you've used it. But with gasoline, it's kind of hard to tell how much gas you've used, right? Because our gas tank doesn't tell us exactly how much we've used or how much is left. So really, when we purchase gas, we go ahead and count it as an expense at that time. So when we bought the gasoline for $50, that's a $50 expense. We didn't pay for it, right? It says we bought it on credit. That doesn't mean we used a credit card. It means we bought it on account. So we're going to pay the supplier later. And we call that an account payable because we have to pay that supplier later for that account. Okay, so we credit that account. It's a liability and it's not part of deal, so it increases on the credit side. Then we go to G. We did another hauling job for $750. So that's more revenue. We've done the work, so we can count that as revenue. And it says we were paid cash, so we got $750 of cash. That goes up on the debit side. And those are all the transactions. So now what we have to do is total up each account. All right, we go to our cash account. We had $12,000, plus we got 600, plus 750, right? But minus the 800 that we paid out. So we have a balance of 12,550 in our cash account, and that is a debit balance. Another way we could have done that, I added up the debits and I subtracted the credits. You could do it that way, or you could just say 12,000 minus 800 plus 600 plus 750. So either way, doesn't matter, you come out to the same number. So our ending balance in cash is a debit of 12,550. There was only one transaction in truck, so that's pretty simple. Our ending balance is a $10,000 debit. Hauling revenue, our ending balance is $1,950, right? We had two credits, we just add them together. Accounts receivable. We have a debit minus a credit. We have $600 remaining here on the credit side, right? 1,200 minus 600 leaves us with 600 still on the debit side. Accounts payable, we have a $50 credit balance. That was the only transaction. Gas and oil, we have a $50 debit balance. Prepaid rent, we have an $800 debit balance. And common stock, we have a $22,000 credit balance. So we have finished this problem, but there's one more thing I want to show you here. Remember that our debits and credits should always equal. So if we want to check our work here, we could take every account that has a debit balance, cash, truck, accounts receivable, gas and oil expense, and prepaid rent, right? Those are the accounts that have a debit balance. Let's add those all up, see what they come out to. So there's the cash, we'll add the truck, we'll add the 600 in accounts receivable, the $50 gas and oil expense, and the 800 prepaid rent. So that totals $24,000. So if we add up all of the credit balances, that should also equal 24,000. Now we're not going to count this credit because that's not a balance. That's not the ending balance, right? That was just one credit transaction. Same thing over here. The cash account had a debit balance, as did accounts receivable. So what are the accounts that have a credit balance? Well, hauling revenue has a credit balance. Accounts payable has a credit balance. And this common stock has a credit balance. So let's add those three up. We have 1950 hauling revenue plus the accounts payable plus the 22,000 in common stock, and it does equal 24,000. So our debits equal 24,000 and our credits equal 24,000. So it looks like we did this correctly. The other problems you get to do on your own. All right, there is 10 minutes remaining with our allocated time. What questions do you all have?
I just have one question. The truck,
Yes.
it actually goes to common stock because it has common stock has 22,000.
Yes, it does. So an investor can contribute things other than cash. So if an investor says, hey, I've got this truck, do you want it? And the company says, sure, the company can repay that investor by giving them stock. So the company receives an asset, whether it's cash, a truck, a building, whatever it is that the investor is contributing, and then in exchange, the investor can get common stock or preferred stock, but we'll learn about that in a future chapter. So yes. Okay, any other questions? All right, well, thanks for hanging in there. I know we went through some of these kind of quickly, but I have in the past run out of time, so I'm trying to make sure that that never happens again. We did have a little time to spare, so I'll give you back those extra 10 minutes and email me if any questions come up. I'll post the lab as soon as I can, and I'll see you all next week. All right, bye-bye.